What is going on, everybody? Q here from Hyperstocks. Thank you so much for checking in. Today, we're going to go over what happened in the market last week, what transpired over the weekend, and what we can expect for the week ahead. If you don't already know, every week we're putting out an update on the S&P 500 or SPY ETF in this case. So if you are not already subscribed, please subscribe or follow us on social media. So let's dive right into it. Let's go ahead and talk about what we closed out last week. So last week, the S&P 500 or SPY closed at 438, so just above that 10-day moving average, which is this orange line, which is currently acting as our only moving average support. To the bottom, we have a support at 428, which was Friday's lows. So going into this week, the most critical support that we need to hold is going to be Friday's lows at 428. If we break below 428, then we can potentially come back down to retest that 420 mark and then potentially even 410. So we want to avoid coming back down to 410 because that is the lowest support that the correction came down to and bounced. So when we came down on Thursday, which is the day in which the Ukrainian invasion actually became official, or the Russian invasion to Ukraine actually became official, we came down to that 410 support and we bounced. Now, many people are asking why we bounced on this day because it's a really big question mark. Of course, leading up to this event, the market was selling off. It was scared. People were selling their positions. They were closing their positions. Why, on the day of the event, does the market bounce? This is a very classic event on the market. This happens all the time. Buy the rumor, sell the news. This is a quote in which a lot of traders follow. In this case, it was sell the rumor, buy the news. So until the invasion, the event until the invasion actually took place, the event was not really official. The day that the event took place, something else called buy the invasion on the market shows a long history of markets bouncing on the days of an actual invasion. So, of course, many bears got trapped into this decline. Many bears, the moment the market opened, must have bought puts, and they pretty much got their positions handed to them when they saw the market bounce. So, and if you were caught in that experience, just try to understand you don't want to trade based off the news and what you think is going to happen. You want to trade based off the charts and what's actually happening in front of you. So when a move of that much volatility takes place, just avoid the market. Just don't do anything for an hour or so. Try to figure out what's happening. Try to figure out what the market's going to do. And then you want to jump into your positions. So the biggest piece of advice going into this week is going to be avoid trading for the first hour if you're looking to hold for more than an hour. So if you are the type of trader that goes into a trade and you like to hold through the ups and the downs of the day, then you want to avoid trading for the first hour unless you're scalping, because the first hour is going to be the most volatile and you're not going to really know what's happening on the market just yet. Just like this happened here, we see that the markets for the first hour on the big drop, they were kind of just hanging out down here. So many people thought they would keep coming down. But then with that volume, you can clearly see that it was a full-on reversal. So if you had just waited a little bit, you would see that there are signs of confirmation that the market is going to go in a different direction. Now, to the upside, we're not only going to focus on the bottom, we are expecting markets to go up this week. So we're personally bullish, but that could change depending on the updates. I understand futures currently are down. We're down by 500 points, but that doesn't necessarily mean we're going to open in red territory or territory that's going to take us back down either way. So going into tomorrow or going into this week, we want to avoid closing below 428. We want to maintain that 428 mark. To the upside, we want to break above the 438 mark. That could lead us to 448 to 450. So that's going to be the biggest thing for us. So if we break above 440, then we can go to that 448 to 450 mark, and enough buyers will step in. Now, one of the biggest questions is going to be, where are we safe? Are we safe right now, or are we going to be going down further? The truth is, we're not going to be fully safe until we get back over this double top pattern right over here. Of course, the closer we get to it, the better, the safer we will be. But double top patterns tend to be a very harsh pattern on the markets. When they do take place, double tops and triple tops, they send markets down significantly. And I'm going to show you multiple cases here. You have the triple top pattern right over here. You have a double top pattern right over here, and then you have another double top pattern right over here. So you can see that every time these patterns occurred, markets were sent down very strongly. So we want to avoid these patterns going into this week. We don't want to hit 440 multiple times and get rejected back down. We want to break above 440, and we want to maintain that strong volume that we had Thursday and Friday to give us that momentum that could take us potentially to test 458 to 450. Now, looking at the bigger picture, we're very unlikely to ever rally back to all-time highs. If we were to recover, and we expect us to recover, it's going to be a very choppy one. We're going to look something like this. You should expect a move like this from the market. So something along these lines where we slowly push back up. The only way that we would ever go vertical is if there was a very strong positive catalyst. Now, the only strong positive catalyst that we foresee in the near future is going to be one, Putin deciding to negotiate, because there are a ton of sanctions against him right now and against Russia. So he may want to negotiate. That could be one. Number two, the Fed meeting that's coming up on March 16th, I believe. The Feds are supposed to raise interest rates for the first time since the pandemic hit. If they decide to raise interest rates by a lower amount than expected, then we will rally. The market would love to hear that, because low interest rates are good for the stock market, because it makes things a lot cheaper for companies. It'll make loans a lot cheaper for companies because they don't have to pay such high interest on them. So other than that, some things to pay attention to this week are going to be oil and precious metals. So if we're looking at futures right now, as the S&P futures dropped, we see that oil futures jumped. So this is crude oil futures. They jumped. We came from a low of 92, which is where we closed on Friday, to a high of nearly $100 today. Now, keep in mind, this is something historically shown. If we look at the history of when the invasions happened in 2014. So 2014, we saw Russia also invade a country called Crimea. And when this happened, the market reacted very similarly. We saw oil and gold jump, while the S&P 500 took a sharp dip during this time. So when this took place, just like now when the invasion actually happened, the market reversed. So we saw S&P 500 reverse. So Putin attacked officially in February, March, and then the market reversed back up, and then oil began to sink back down. So this week, you really want to pay attention to those signs. If oil starts to show weakness, if precious metals also start to show weakness, like gold and silver, and we see strength coming into tech, then we can potentially start seeing the reversal to the upside. I know it sounds a little crazy. However, in reality, markets they have a long history of proving that they move the opposite when the actual events happen. So look for weaknesses in oil, especially oil stocks, so like CVX, which is Chevron, and then you want to look for weaknesses in gold. So if gold and oil begin to show weakness, and then tech begins to show strength, then we can potentially be on the signs of a reversal. But either way, I've given you guys levels to work with. Obviously, the most important level for the S&P 500 to maintain is going to be that 428 level that we closed out on Friday. If we would come down below it, then we can potentially test that 410 mark again. Thank you guys so much for checking in. I hope this video was helpful. If you found it helpful, please subscribe to the channel for a weekly update.